Alrighty, you guys should be able to hear me. Let's get going here. We're going to go through the wing spreads today. This class is a production of Safe Option Strategies, and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for educational purposes only. Safe Option Strategies does not make any recommendations to buy or sell stocks or options. Trading stocks or options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. To start off, I'm going to pull you guys over to our account that we were doing with you earlier today. I don't know if you noticed, but Baidu this morning is down $13.62. And if I was to show you what that looks like in real life, you guys would go, Kevin, we're getting killed. And yes, we would be getting killed in Baidu, the tune of like $26,000 today, $21,000. Let's see if Baidu will come up for us here in just a second. Come on, positions. So Baidu is taking a beating. As I open it up, here we have Baidu right here in the middle. I'm going to go ahead and I'm going to take a pen. I'm going to highlight it in a lighter green color. We have 7,400 Baidu shares that are down $13.51. Well, our short call, that covered call, is making up $2.55. Net, we are down $11 on the position. You may have heard us talk about this in the past. A covered call, a short call, the obligation to sell, a credit of $6.23 when we put it on, is not protection. It just buys you a little bit of time to add those long puts. Long puts are protection. The short calls are not. The short calls are literally just there to give you a little bit of time. Thank goodness we have some long puts that are making up the difference. But my big loss today is the fact that when the stock and the short call are down $10.95, on some of my puts I'm making up $8.92 of it, and some I'm only making $6.47.5 on it. So the short answer is I'm basically losing $2 here, and I'm losing $3.50 here. A question that comes up over and over and over again. Well, Kevin, shouldn't you always have your long put protection on? Shouldn't you always have that long put protection on when you trade or own a stock? And of course, the comment is no. No, if you're going to spend for quarter after quarter after quarter $12.42, just doing the math, you're going to spend about $50 a year on a stock that's trading at $180. Was trading almost at 200. So putting this into perspective, your stock has to move about 25% before you'd ever make a profit if you always had protection on. And it's rather interesting because some of you are going to say, well, Kevin, can't stocks move 25% a year? And the answer is, of course they can. But not only can they move 25% a year, the question is, how many do you know that will move 25% a year, or that will guarantee that you're going to make that profit? And I don't know very many. I'll be honest with you, I just don't know very many. With that said, trading is a process. Jeff said, what was the reason for the huge drop? Well, the reason is Baidu has people that advertise on it because Baidu is the Chinese Google. So over the weekend, One of the companies that advertised on Bybee advertised that for people with cancer, they've got a product that helps fight the cancer. Well, a college student in China that has cancer went on the site, saw the thing, bought this product, and he ended up dying. He had cancer. Cancer is near and dear to my family. I've got a brother and a father with cancer. I don't want to make light of a death involving cancer, but people die when they get cancer. There are not cures available that magically fix people when they have cancer. So the fact that someone used a drug from a company that said it helps fight cancer, it does not mean that they're automatically going to live. It does not mean that they're going to beat cancer. It's really a foolish reason. So as I spoke with Jeffrey this morning, this is a buying opportunity. This should be something that'll weed itself out. It would not surprise me to see Baidu back towards 195 by the end of the week, but you never know. You never know. Kind of a foolish or ridiculous reason to see the stock market down on the fact that someone that bought something that was advertised on Baidu that had cancer ended up dying. I mean, the comment is, well, of course they had cancer. More importantly, how does that affect our trades? Well, taking a quick peek, dang it, we've got a Baidu vertical that we still have not been able to close for a profit. So we're in a little bit of trouble here. We're sitting here going, for crying out loud, I've got to get a profit. We have until the third Friday in May, which if I look at my calendar, the third Friday in May, this will be the first Friday. So we have 3 full weeks till we've got to see Baidu to get our maximum profit be above $1.85. Now, if I take a look, 361, 1088, hey, it actually cost us about $2.80. So if I work my facts and figures here, I have the right to buy Baidu at 180. If it costs me $2.80, I'm going to add $2.80 to that. My break even on Baidu to make a profit on this bullish call, an 80-85 bull call spread, I need to see Baidu trading at about 183. 183 will give me a profit in Baidu. Couldn't we, shouldn't we, weren't we trying to, for the last couple of weeks, trying to close this position? We were. Of course we wanted to close it. We just never got our target profit, and then we had some bad luck, bad news, Baidu's tanking today. So, out of curiosity, we only have the ability to spend $48,000. We don't have a whole lot of money here. What would our adjustment be on Baidu in this position? What would our adjustment be on Baidu? How would we fix this trade that's obviously not working for us right now? Have the right to buy it at 185 or obligated to sell it at 185. So obligated to buy at 180, have the obligation to sell at 185. What would we do to adjust or fix this trade? If you don't know, put a couple question marks in. What could we do to adjust or fix this trade? Well, I've got a short call already there. There's a good idea. Emily says you have a short call to try to make up some of the loss. That is correct. We have it right there. That's going to expire when our long call expires. But Emily, you're on the right track there. Keeve, any idea what you do? $180. So Keeve just said you buy back those short calls. What we sold for $10.84, we could buy back for $3.72. That's not bad. That's a pretty good profit. But unfortunately, what we bought for $13.61, we can only sell right now for $5.97. So we've made up $7 here, but we've lost $8 at the top. So there are a couple things you could do. You know what? I'm just going to get out of this trade. I just need to exit this trade. I don't have money. I need to exit the trade. That could be an idea. In fact, as I take a look at it, since we only have $48,000 of buying power, a good idea, since we're down, would be to close half of these. Let's go ahead and let's take a dollar loss. Let's take a $500 loss on half of them. We're going to cut our losses. We're going to make sure that we're not going to get creamed on it. So on half of them, we're going to book a loss of roughly $1. Kevin, why are you doing that? Well, I'm going to have to make some adjustments here or fix a couple ideas. I'm going to have to fix my trade. So as I'm taking a peek at it, I've just limited my risk. I should have an ability to put notes in here. Maybe it doesn't allow you to do that. All right, well, here's what you have to keep in mind. We just booked a dollar loss, which means we need to add $1 onto that $2.80, which is now $3.80. The most we can make is the difference in two strike prices, which is $5. So I still have a profitable trade in place here. I can still make $1.25, right? Difference in two strikes minus my debit, $1.20. Still have opportunity to make $1.20 by closing down half my positions. But what's my adjustment? What am I looking at to be in this position? Well, I know a covered call can give me $10.84. As Emily looked at, she goes, Kevin, man, if you short another covered call, man, you could make like $10.84. That makes up for $3.80. You're in good shape. You can do it, right? Kevin, you can do it. So what I need is the stock though. So right now I'm sitting in this trade, literally seeing if we're going to get a bounce the next couple days, because what I'm going to do is I'm going to need to buy the stock at maybe $180 a share. The most I could lose in this position is 380 times 500 I'm only talking about, and I know it kind of sounds brash to say this, I'm only talking about 0, 0, 0, carry a 4. I'm only talking about a $1,900 loss. If I just leave it where it is right now, the most I can lose is $1,900. I can no longer lose $2,850. I've lowered my risk in the trade. The most I could lose is 1,900 bucks. So my thought process is I need to see where Bybee is going to be trading in 3 weeks. Is it worth it to have the right to buy it at 180 and then go out and time another month to try to pick up another $10.84? I still give myself the ability to be profitable if it goes to the upside. And the maximum that I could lose is $1,900. So if it goes all the way down to 150, the most I could lose in this trade, because it's a debit spread, what I paid for it, the most I could lose and take is my maximum loss of 1,900 bucks. Right now, all I did for my adjustment is said, hey, in the future, I might have to buy some stock where I'll have to do nothing more than short a call against it. And if it goes all the way down, loses another 30 bucks, I don't lose 30 bucks times 500, $15,000. The most I could lose is 1,900. I feel like I'd be okay in that position. But notice, if this was stock ownership on a stock that's down $15 today, if you were just buying the stock and waiting, if you were trying to day trade this and you woke up this morning, wow, on 100 shares, you'd be down 1,500 bucks today. On 1,000 shares, you'd be down, actually on 100 shares, you'd be down 15,000, right? And on 10, if you had 1,000 shares, you'd be down 150 grand. The beauty of using some of the spreads trades is you have a maximum loss already set in place, and you're not risking some of these bigger dollar figures that you could be with stock ownership. Looking at Disney, we do have stock ownership. We are protected at 105. It has its earnings coming out, I believe, on the 5th or the 10th. I cannot remember, which means if you can't remember, you might as well check it and make sure you figure it out. Disney has its earnings on, as it's loading the data. I guess our internet connection is a little slow here today. On the 10th, so it's next week. Don't have to worry about Disney right now. On the flip side, Home Depot has its earnings, I believe, on Thursday, the 5th, Cinco de Mayo. Nope, it's on the 17th, so we don't have to do anything with Home Depot either. As we're taking a look and going through our accounts, D's is protected for earnings coming out next week. Home Depot, we're just trying to lower our cost basis, Home Depot, we're just sitting here waiting for it. Not much to do on Home Depot yet. Hopefully we'll see a run up on Home Depot before earnings so that we don't have any worries or concerns there. Netflix got crushed, and you know what? We put on a call vertical. What we sold for 75 cents is now worth only 34 cents. So let me say that again. What we sold for 75 cents today is only worth 34 cents. But the stock's up $1.22 today. I know, and we're only down 2.5 cents on our vertical. how fun is it to sell something for 75 cents and to buy it back for 34? Remember I said we want to be in this trade to only get, what, half of our credit? It's impossible to adjust. It's a bear call spread. It's impossible. It's hard to adjust. Why don't we go ahead and buy something back for a lot less than we sold it? We'll close and adjust this trade. We're going to buy it back for a lot less than we sold it. Kind of like selling something, selling a car for $7,500 and then buying it back for only $3,400. Seems like a pretty good deal. Off we go. We're going to try to take our profits there and be in good shape. Visa. We had some good puts. We're making some good money. In fact, Visa looks really good considering we bought it at 71. Boy, we're doing pretty good in Visa. Had it protected, haven't lost any money on the downturn. Visa's up 66 cents today. You know what? I might have to buy some of this extra stuff up here on Bybee. I might have to. Kevin, what do we do? Well, our lower puts are protecting 200 shares. We spent $2.55. We can sell them for $2. You know what? I'm just going to close it. I'm going to close those protection because Visa seems to be bouncing higher off of that 77.50. I'm just going to close that since we're probably not going to need it anymore. That means on my 500 shares, I've got 200 shares that are no longer protected. Shares that I bought at $73.15 are no longer protected up here at $77.91 where it's trading at today. Well, why don't we take a bit of a profit again? What if we go ahead and we sell off some of those shares, sell off the covered call? If we don't have any protected, we're going into the sell in May, go away. Let's go ahead and the 200 that's not protected, let's take our profit. We're starting to protect our portfolio. We're starting to sell off some of our winners. We'll still have Visa, but we're going to go ahead and we're going to make some money here. We're going to book a profit. The little O there stands for orders. And hopefully that'll fill while we're here today, and we'll take some profit off 200 shares of Visa. A couple people will always ask me, Kevin, why did you do this? Why would you do this? Is that what you would do in real life? And in all honesty, yes, it's exactly what I do in real life. We have next week Disney that can make us some great money. We have Home Depot. Should make us some great money towards the end of May here. We have Netflix, which we're taking a killing in, but check this out. What we paid at 107, we still have the right to sell all the way up at 115. What we bought at 107, we can literally sell at 115. In fact, we might just, at the end of May, go ahead and let those shares get called away. Just say, you know what, it is what it is. We weren't seeing the movement in Netflix. We've got the right to sell. Let's go ahead and let's take the right to sell and be done with it. Not a bad position to be in. I'm going to take a quick look at orders. Oh, there goes Visa. Visa just sold off. So would I do this in real life? Yes, I'm creating some buying power in case I have to buy Bybee. And as I'm looking, we're pretty well diversified. We're international in technology. We're in consumer discretionary and entertainment. We're in Home Depot, which is again consumer discretionary and the material sector. We're in Netflix, which is our high flyer. Probably have too much in Netflix. And we're in Visa, which is our safe, steady Eddie. I like our portfolio. I would sit back where it is. But really what makes the difference is we have a lot that's coming up this week. This week we have significant economic events. And on Sunday, if Jeff would have looked ahead of me before church started, I sit down and I spend about 20 minutes writing in my at-a-glance binder what's going on this week. Today we had the ISM index and construction spending. It disappointed. Market expected the ISM index to come in at 51.4. It came in at 50.8. It shows our small business is shrinking. Construction spending, big buildings expected to come in at 0.6, came in at 0.3, half of the growth that we were expecting there. It's still up, but not good. Tomorrow we have auto and truck sales, and then Wednesday the big numbers start to come in. ADP employment, how many new jobs are created? Market expects 196. Briefing thinks it's going to be higher, but this is going to be a catch-22. Hey, catch-22. If we have more people are getting jobs, we have better employment than expected, does that mean that the Fed is going to raise rates in June? Is good news good news, or is good news bad news? We don't know right now. We don't know how the market's going to react. Rather big Wednesday employment. Wednesday at the ISM services. Are the small business services index going to grow, or are they going to disappoint like small business manufacturing did? Thursday, initial and continuing claims, but Friday is called the average work week. Friday is a very big economic day where our market can be up or down by 200 points. Average work week is the title of all these reports. It really comes down to non-farm payrolls. Real jobs, white-collar jobs out there, are they coming to pass? Are we growing more than we expected? Briefing thinks it's going to. Private payrolls, private jobs, small business jobs, are they going to also grow? Unemployment rate should probably stay at 0.5. Hourly earnings is going to be up 0.3%. That helps GDP. Consumer credit, big help to Visa there, right? Are people buying or putting more stuff on credit? Well, Kevin, isn't that a bad thing? Well, in real life, yes. Look at the United States. Look at some of your neighbors. If they're debt-ridden, so to speak, has so much debt they're just living off of credit cards, obviously that's not going to be a good thing. But the way the market looks at it, the more people that are using credit, they expect them to have the ability to pay it off over time, which most of us do. So a higher consumer credit number bodes well for expectations of growth into the future. A very big volatile week. It'll be interesting to see where things end up. I could not even give you an idea of what's going to happen. So because of that, I call her. Because of that, I look at where we're at, what we're going to do. I take some profits. Hey, if I'm uncertain what's going on, well, crud, let's take some profits on Visa. Let's take that off the table. Not all of it. We'll take off a third of it. Not a bad position to be in. We don't want those calls though. We gotta close and adjust so they all line up there. I noticed we had more calls there than we should have. Good thing I caught that one. Remember I told you you'd never have naked calls by itself. Never ever have naked calls by itself. We just had a comment that I'm not allowed to repeat over the air. All right, so am I comfortable with this? I hope so, because this is exactly how I'd run $100,000 of new money. I'd have a spread trade or two trying to gain some profits. We've done really well on our spread trades. I'd have some stock ownership positions that we try to do as good as we could here. Not a bad position. Again, I still see us up profitable, $6,900 for the year since we started. Not a bad position to be in when it's all said and done. Let's get to our education today. Today we're going to go over wing spreads. Again, this is another version of a credit spread. But wing spreads have a time and a place when our stock market is extremely flat. Kevin, can you give me an example? The last time wing spreads were a great, let's get started, let's take it, let's let's just expect the stock market to trade in a range. You'd have to go all the way back to 2005. So let me see if I can't bring up a chart. On the S&P. I'm going to bring out this chart to like 15 years. Definitely has to be the internet. Emily, Jeff, am I still, you guys are able to hear me halfway decently? Thank you, Emily. All right, good. Thank you, Jeff. All right. In 2005, we had a period where the stock market was extremely flat. And I'm just going to bring it right in here. Each one of these bars is a month. So we literally had a 4-month period where the stock market moved 0%. We had 2 months where it moved 4%, and then we went through another 4-month period where the stock market moved literally less than 2.5%. In 2005, all of a sudden you started hearing some comments on iron condors or wing spreads, a strategy where you could it's just like an ATM machine. You just put the trades on and you start to bring in 2 to 3% on your money every single month. Well, taking a look at it, kind of interesting, because in all reality, the last time it was able to do that was right there. We don't have, each one of these is a month. We don't have another stagnant period. In fact, look at these volatilities. Look at some of the drops month in, month out in 2008. Horrific. Nice run back up, pull back. Nice run back up, 3 months, huge drops. We don't have another extended period where you have the market in a really, really, really flat range. So, with that said, Kevin, why are you teaching me a wing spread? Well, in 2005, it worked really well. And in all honesty, we might have a period where the market is stagnant, where we just finally catch up to ourselves and we don't grow. So with that said, You need to have the ability to understand what's going on and why. And I'm just trying to get my chart here. So I guess plain and simple, that's why we're going to teach you wing spreads. One is called an iron condor. It's a credit spread. Out of curiosity, what do you think my stance is on credit spreads? Am I a big fan of credit spreads? I've got Keith shaking his head saying, nope. No, it's a credit spread. It means you take a little bit of credit and take too much risk. With that said, do I have to adjust into those? Of course I do. On an iron condor, you sell to open. This strategy is a combination of the bear call credit spread and the bull put spread on the same stock in the same month of options expiration. If that doesn't make a whole lot of sense, I'm going to show you a chart. But what you're doing, a straddle or a strangle is a double debit trade. A wing spread, or in this case an iron condor, is a double credit spread. You're going to put two credit spreads on. You're going to take a credit on your bear call. You're going to take a credit on your bull put. Hey, if you're going to put two credit spreads on and have two obligations of like $5 minus your credit, how long do you think you should be in the trade? How long do you think you should be in the trade if you're going to have a double credit spread? Short term, there you go, Emily. Jeff, any idea? Don't hesitate to copy Emily if you need to. Keith just said 30 days or less, and Keith nailed it on the head. 30 days or less. 30 days or less is where you ought to be in the trade. Yes, Jeff, really short term. The cost base is the total net credit of all the options subtracted from the difference in the strike price. And actually not the cost basis, that is the risk. Cost basis is the total net credit. Okay, I understand what he's saying here. I'm gonna put this a different way. Your cost basis, your net credit is your total net credit. Your cost basis, or your risk in this case, is your total credit minus the difference in the strike prices on either side of your trade. Maximum reward is a net credit. You can't make any more than your credit. Good return is a 15 to 50% return. A good target return is 4 weeks or less, 30 days or less. What does it look like? Here's a great example. Occasionally you'll have a stock like Nike. Nike where it's trading flat for a period of time. The expectation is you're going to continue to see Nike trade flat going out until options expiration in May. Why? Well, it's pretty easy to see a line right up there, and it's pretty easy to see some support right down here. It's already traded 1 week, 2 week, it's already traded 6 weeks in this range. And with earnings coming up, earnings is about the only thing that might change that range. You can see this is probably earnings. Nice volume, a gap up, yet it couldn't quite break out above, as I'm looking at Nike, couldn't quite break above that 102 range, which probably means at 101, 102, there are a bunch of orders stacked up where people are looking to sell right in this range, probably because they bought it right down here, $10 cheaper at 91. So people are saying, hey, 100, 101, 102, we take a 10 to a 12% return. We do it in 1 month. In 2 months, we're good to go. Looking at Nike, I'm going to place 2 credit spreads. I've got my sideways movement. I've got well-defined levels of support and resistance. I'm going to do my bear call. 102 short call, 104, 105 long call to cover that naked short. I'm going to create a credit spread on the top side, a bear call spread, what we just went over a week or two ago. My expectation is that Nike will not trade above that 102 level. Past history shows me once, twice, 3 times, 4 times, almost 4.5, because this one doesn't quite count. 4.5 times couldn't get above it. That's a pretty good track record. I would feel comfortable at 102, 104, 105 on that long call. I could create a 30-day or less bear call spread expecting to keep my credit. I'm going to be in good shape. But you know what? I'm going to be greedy. I want to do a double credit spread. I want to make double the credit. So I'm going to come down here, give me a little bit of wiggle room, because the best adjustment for a bull put, right, is owning the stock, which I don't want to own the stock. I just want to be greedy and take my credit. So I'm going to do a 97.50, 95 bull put. I'm going to take a credit in this spread right here. I get a credit up top, a credit down below. Man, I'm getting paid twice to be in this trade. And that's what I hear all the time. I'm going to get paid twice to be in a trade, Kevin. And I kind of scratch my head, because in all reality, let me ask you guys a question. Can't the stock break out above here and then have a bad day in China and fall back down to here? Can Nike move that way? I hear one yes. Emily, Jeff, is there a chance that Nike could move above that short call on your bear call spread and then move all the way back down and be below your short put? Jeff says yes. Jeff, knowing you, I can kind of see the grin on your face, and I can hear you saying, well, if I put this trade on, that's exactly what it would do. I've heard that from people. It's funny because as we're working on maximum risk, the maximum risk is only calculated on one side of the trade. But in real life, you know what could happen? We could get into this trade, the next day it gets up here and we get scared out. We get scared out and we take a loss up here, but we think we're okay down here. And then a week later we hear that, dang it, those Chinese are using child labor and they've got 5,000 kids making Nike shoes, and the stock drops and it could fall below that short put price, and we could also take a loss here. So as you're looking at the risk in this trade, keep in mind it's one that you'd have to be in until the trade expired. What do we mean by that? Well, in this particular position, we're going to give ourselves some room. If the stock was trading at 135, we knew it doesn't seem to get above 102, doesn't seem to get down below 98. We're going to give ourselves a buffer and put our short call at the 105 strike price. We're going to put our long call so we don't have a naked short call at 1010. As we work our credits, we're going to be creating a credit spread, a bear call spread on the top side. But we're greedy. We want twice the credit. So we're going to put our short put at 97.50 and cover that with the long put. And the long put actually, in this case, should be placed below it. So I need to work with Jeffrey on his slides. Yes, I do. Keith just asked if I send the revised slides. Yes, I do. So here we go. Taking a look at our trades, we've got a bear call in the red. We've got a bull put in the green. We are literally creating two different credit spreads. Now, what is the risk on either credit spread? What is the risk on either credit spread here? Think about it. What is your risk on either credit spread here? Isn't the risk just the cost of the trade? Well, that is on a debit spread, but Jeff, are we on a credit spread or a debit spread here? We're on two credit spreads. So we know we get our credit, right? On a credit spread, the risk is the net credit minus the difference in two strikes. Up here we have a 110, we have a 105. What's the risk on our bear call spread? The red one's there. $5, right? Minus the credit. How about down here? We've got a 97.50 and a 92. What's the risk in the difference in two strikes? Man, I'm obligated to buy at 97.50. I've got the right to sell at 92.50. Let's work that out. I've got the right to buy at 97, but if I sell it at 92, what am I going to lose there? There you go. $5 minus the credit as well. Perfect. You guys both got it. Keith, you on board there? Yep. So our risk is $5. There's not a benefit or less risk on one side than the other. Could you change this one down here, the long put, and move it to maybe 95? You could. You wouldn't get as much credit, but the short answer is on either wing, we have $5 of risk in the trade. So with $5 of risk in the trade, if you don't touch the trade, the most you could lose is difference in two strike prices minus your net credit. We've already talked. Is it possible to lose on one side, then the next day lose on the other? Yes, it is. So a word to the wise. If you're going to close down one side of the trade, be prepared to possibly lose on the other. It's a double credit spread. So if you ask me, you're taking twice as much risk on each side being greedy to get two credits. What do the numbers look like if we were to use real numbers here? Well, if you use that 95, 97.50 like I just said he should probably do, right? You take in a credit of $1.31. You take in a debit of 80 cents. As you work those numbers, it's 51 cents per share. Obviously, Jeffrey is listening to me. How much risk is on the bull put spread right there? How much risk is on the bull put spread? Well, I'm obligated to buy it at $97.50. I've got the right to sell it at $2. If I take 51 cents of credit in, there you go. There's about $2 of risk, right? I get to keep that 51 cents, but I'm obligated to buy at $97.50. I've got the right to sell at $95. $2.50 minus 51 cents, I've got about $1.99 worth of risk on the put side. Comes right back down to rights and responsibilities, right? Obligated to buy at $97.50. I've got the right to sell at $95. If you buy stuff at $97.50 and you sell it at $95, you're going to lose $2.50 on that transaction. Kevin, why didn't he go down? Why didn't he go down like in his other drawing? Why didn't he go down to the $92.50? Well, taking a peek at that, it increases the debit by 48 cents. So if we had 51 cents of credit and we add another 41 cents of debit, you only get 3 cents of credit. Would you want 3 cents of credit on $5 of risk? Do you want 3 cents of credit on $5 of risk? Hopefully the answer is no, right? All right, so, well, let's take this into consideration. If we don't have to take that put and we can replace that put and get it cheaper, let's work some different numbers. Let's work this with the $5 spread. There's no 95 there now. If we took in $1.31 of credit and we bought the $92.50, what is our net credit in the trade? Well, keep it simple, right? Let's keep it simple. Okay, I take in $1.31. I've got to pay out 48 cents. Well, if I work on my calculator, I take in $1.31, I throw out $1.48. Hey, now I've got 83 cents of net credit. If I do my math right, Kevin, I now get 83 cents of net credit. I get 32 cents more if I do it this way you're showing me. Ah, but Emily got it. But what's the risk now? Instead of $2 of risk, where you get 60% more credit, right? Well, difference in two strikes. I've got the right to buy at 97, or I'm obligated to buy at 97.50. I've got the right to sell at 92.50. Man, that's $5, right? $5 minus my net credit of 83 cents. My new risk is $4.17. Kevin, which one is better to choose? The 92.50, 97.50, or should I choose the 95, 97.50? Well, guess what? There's less risk at the 95, 97.50. You only have $1.99 of risk. If you increase your risk from $1.99 to $4.17, if I was going to increase my risk like that, I'd want double the reward. You don't get double the reward though. You don't get another 51 cents. You only get 32 cents more of credit. That's why Jeffrey took a look at this and said, hey, on the previous slide, you could do a 97.50, 92.50, but as you work the numbers, you realize the best bang for the buck is a 95, 97.50. Emily types in, so someone's risking this trade, is hoping the stock never goes down that far so they can just take the credit. Bingo, Emily. Hey, on our chart, we saw on our chart, we saw that it looks like it's not going to go below 97.50, right? We did our technical research, and we saw it shouldn't go below 97.50. We actually can say, hey, 1, 2, 3, 4, 5 times it tried to go below it, and it couldn't do it. It stayed above it. So that gives us the confidence to say our expectation is that it will not go down to 97.50, so we can go ahead and take our profit. We win as long as it doesn't go below 97.50. We win as long as it stays above 105. Yes, we want this stock to stay stagnant. Wouldn't a straddle trade be a lot less risky on a volatile stock? Okay, now Emily, yes. A strangle straddle would definitely be less risk because it's what you paid for. But looking at this position, would you put a strangle straddle when you need significant movement to take a profit? Would you put it on this type of chart right now? There you go. No, you wouldn't. So you would wait 3 or 4 weeks, and you'd put that strangle straddle on before the next earnings. Would a strangle straddle work on Nike looking at this chart? Most definitely. Look at that gap. It went from $97, $98 it looks like here. It went from $98 where it opened in the morning, and the next day it went as high as $102.50. Oh, there's $4.50. There's a 5% movement in a day. On a strangle straddle, boom. You'd get in one day, out the next. You'd be really profitable. In fact, you don't want to do it the day of earnings. You'd probably want to do a week or two before. So just let's take a quick peek and look at this chart. 1, 2, 3, 4, 5. So if you did it the day before, maybe at the open, you might have put a strangle straddle on at 96 and watch the stock a week later go up to 102.50. That's an $8.50 move. That's almost a 10% movement. Strangle straddle at earnings a week before would be a great trade based off of this chart pattern on Nike. But right now we're playing the stagnant trend. Had its earnings couldn't go higher, we're playing the stagnant trend up into the next earnings point. Yes, Steve. Maybe. Keith just said, Kevin, should we be concerned about what happened last year at May? Would have been a terrible trade. This would have been a terrible trade. The short answer is maybe, but remember, we're only in it for really 2 more weeks. So let's take a look at a chart and let's see what this did in real life. Back testing, always a lot of fun. Too bad we can't see in real life what the market's going to do in the future. We can only see what it did in its past, right? But that's an interesting question. Going back to Nike, I need to spread it out a year now. Year and a bit. So if you go back to February and May of last year, was this a horrible trade? Oh yeah. This broke way above. Although Nike split 2 for 1. So this actually 52, it actually traded up to 104. So would this have been a horrible trade last year if you got it in real life? Yep. You'd be adjusting it. You'd be taking legs off. yes, this would have been a horrible trade to be in last year. Now, Key made the point. Well, Kevin, this trade sucked. You don't know it at this point. In fact, at this point, the chart tells you everything's in place to put on an iron condor. So, technically speaking, the setup for the trade is good. You have your technicals that say this is the trade you should do, stagnant trend. You put a stagnant trade on. Would it have been better to use a different stagnant trade like a covered call? Most definitely. Better trade. Goes up, you make a profit. Goes up, you can roll your short call out and up for a net credit. Would the iron condor have worked? Nope. You would have taken in 51 cents. You would have taken in 46 cents. You would have had 97 cents of credit to then get killed. To then get killed because you can lose up to $5 on the top side, right? 105, 110. We had more risk to the top side, and guess where Nike went to? To the top side. You'd keep 97 cents of credit, but you would have taken 403. It got up to 94. You literally would have taken $3.03 loss to keep 97 cents. This would have been a bad trade. It would not have worked last year when that chart was there. Butterflies, another wing spread. This is the neat one though. This can be a debit spread. You can make it a credit spread by selling the open, but you do two short options that are placed at the money. One option is priced at a higher strike. I can go through and just read this to you, but I think it's more important to show it to you. So here you have Nike. Same chart pattern. Same levels of resistance. But instead of putting your two shorts, instead of placing your two shorts right there at resistance, you're going to flip them around. You're going to make them debit trades. You're going to put them up here, right? You're going to put them down here. So you're going to change it a little bit. And a butterfly places your short calls in the money and then places your long calls much higher, or your long puts. But notice how these are all calls. We're not mixing calls and puts. There are two shorts in the middle and your longs are placed outside. This is a butterfly spread. Let's look at how this would work out. Kevin, put it to me in plain English. Well, in plain English, you're doing a bear call and a bull call spread at the same time. You're doing a bull call and a bear call where the short's placed at exactly the same strike. You may hear this term in trading. This is called pegging. Not peggy, pegging. When you think the stock is going to peg at a price, when it seems to be right at that price, you notice this with Apple a lot. Apple at options expiration pegs. It picks a round number, and more often than not, Apple for the longest term would always go through options expiration at a $10 strike round number. 100 used to be the price. Apple would peg at 100 every single time. When it got in the hundreds of dollars, when the Apple is around 400 or 500 or 600, even $700, Apple would peg right around those $100 marks at options expiration month after month after month. Apple only moved at earnings. So in that 3-month period, if Apple got down to $400 a share, you knew for 3 months Apple would almost get right at and peg right at $400. Nike had a while where it also pegged. In this case, if at options expiration, the expectation was Apple would peg at 100, what a fabulous trade to be in. Kevin, go figure. Explain it to me. Well, if you have the right to buy the stock at 95 and you're obligated to sell it at 100, how much do you make in the bull call spread there? If you have the right to buy the stock at 95, you're obligated to sell it at 100. How much do you make on the bull call spread there? $5. Bingo. On the flip side, if the short call expires worthless and your long call expires worthless, and this top spread is a credit spread, and we'll say it's a credit spread of 51 cents again. If you have a 51-cent credit spread on the top side, how much do you make on the top side? Jeff said 51 cents. You got on the top side, you make 51 cents, and overall, you'll make $5.51. All of a sudden, we're starting to throw in a lot of large numbers here, right? You're going, oh, Kevin, this is a great trade. It's a great trade. It's a debit trade. You like debit trades. It's less of a debit trade because the credit on the top side offsets the cost of the debit on the bottom side. Kevin, this is the best trade since sliced bread. This is all we needed. We just need to do a bunch of these. What's the downer, right? What are we missing here in a butterfly? What's the downside of this trade? Well, the downside of this trade is you are predicting that the stock is going to trade to the penny of where you want it to be. Your bet to the penny is that it'll stop at 100. Well, Kevin, what if it trades at $99.95? Well, dang it. Short call. Well, what will happen to the short call if it trades at $99.95? What will happen to that short call? What will happen to either one of those short calls? I'm obligated to sell my stock at $100. Which means someone's going to want to buy your stock for $100. Will someone want to buy your stock at $100 if they can get it cheaper out on the market at $99.95? Never. So guess what? The short calls expire worthless. Your long call will have $4.95 of value. You won't make $5.51, but you'll make $4.95. So if it trades below 100, you're in great shape. It trades below 100, you guys are going to be okay. Let's go the other side though. Let's say it closes at 105 cents. Just 5 cents above 100. Jeff, you're not an idiot. You just got to work on rights and responsibilities. Let's say it trades at 105. Well, I buy at 95. I'm obligated to sell at 100. Dude, I make $5. I'm the man. Or as Emily would say, I'm the woe man. But what happens to the top side of your trade? What happens to the bear call side of it? Well, you're obligated to sell at 100, and you don't have stock to do it. So your broker, if they're an idiot, Jeff, your broker might exercise your long call. You might buy the stock at 105 to turn around and have to sell it at 100. In which case you lose $5 there. If this is the debit trade, you would lose your debit. Would you hope your broker would be smart enough and say, hey, why don't you just buy the stock at 105, we'll sell it for you at 100, we'll take care of that for you? They normally do that, but that creates a relationship that you have to have with them. And yes, there are plenty of idiot brokers that are out there. Taking a look, working some real numbers. If your debit was $3.72, all right, sorry about that. I'm back. Jeff made the comment, are you betting that it never closes higher the entire time of the trade? Yep, that's what you're betting on. Jeff, is that realistic, you ask? Not really. It's not realistic at all. But there are times when you run into a trade like this. And there are occasionally stocks that peg. But Jeff, you just made the comment, is it realistic? And obviously, no, it's not really realistic. Can you get lucky? Yep, you can get lucky. But no, it's not a realistic trade. Yet, I can't tell you how many times I've heard people talk as if they can predict it like there's no tomorrow. Oh yeah, it just does this. Okay, so they did it once and got lucky. And then to act like you can do it every single month, every single time, stupid. It's just dumb. Iron condors give you a little more wiggle room, but obviously iron condors are also just as risky. Are these trades I'm recommending that you learn how to do and that you do? Well, I obviously want you to learn how to do them. I want you to have every golf club in your bag. but this is a 2-iron, which means it's the hardest club to hit. When you hit it and you do it right, it's a remarkable trade. But yeah, it only happens 1 out of 25 times. It's something to know. It is not something to be doing consistently or regularly. It's not been a good market, or it really hasn't been a good market since 2005 to do either one of the wing spreads. But it is something that you do want to know. Questions? Questions about either one, or do you guys need some time to digest it? I thought you said it was a long put and a short put, but it looks like you have 2 longs on the left side. No. Okay, so there, you always have, if you do a put or a call. So let's go back to what you just saw there. If you're going to be doing puts, the shorts are in the middle on a butterfly, and you want to cover your shorts. So you have 2 shorts, 1 long on the bottom, 1 long on the top. A butterfly has your shorts in the middle. Same strike price. A condor will have 1 short here, and the other short will be at a different strike price, where it gives you the range of 97.50 to 100. You've got a $2.50 buffer for the stock to finish in. A butterfly, got to be exact, got to be down to the peg. An iron condor gives you a buffer. In all honesty, neither one is a highly probable trade in today's stock market. In fact, the last time it was a highly probable trade was May 11 years ago. That's the last time either one of these trades was a highly profitable trade. But you'll still hear, and pardon the way I'm going to say this, you'll still hear idiots talk all the time on how good an iron condor trade is, and when you work the numbers, your number one answer you're going to tell them is BS. BS. You can win the trade for some of the credits that they do where they get even a bigger spread in there. If you widen this out and you go like 100 to 95 and you put a $5 spread in there, you're literally trading 3 cents on $5 of risk. And the neat thing is, when you guys get a little better and get a little more familiar with some of these terms, when we spend the last half of this year paper trading, literally looking at trades, coming up with trades to do, taking a peek at what's out there and how to set up trades, you're going to start to hear people through the grapevine, oh, I'm an iron condor trader, I made so much money doing this and that, and then I had 1 loss, but I'm okay. And you're like, bull crap. 1 loss, so you took 3 cents in for 12 weeks in a row. You took in 36 cents for 12 weeks in a row. You had 12 successful trades. And then your 13th trade bit the bullet, right? Bad trade. And you lost $4.97. And you're going to sit and you're going to look at the dummy and you're going to say, okay, so you think you're doing okay because you made 36 cents but lost $4.97? But that seems kind of stupid to me. I'm excited to make 36 cents as long as I can lose almost $5 on the other side. You don't make money that way, you lose money. It destroys and it blows up a portfolio. Good question, Emily. Any other questions on wing spreads? Kind of hard to digest. Kevin, are you going to place a trade on it? Nope. I'm not even going to place a trade on it. I'm not going to waste my time on it. Would I suggest you guys place a trade on it? Certainly, but do it on a weekly trade. Do it something that that's not going to move too much. I don't even have an example for you. Again, I haven't done these for a decade because the market hasn't set up. And even if last year, and I think Keith told it to us, Well, last year Nike set it pretty good. The time the trade seems to set up pretty good is usually the time it breaks out. Would a iron condor have been a good trade on Nike last year? Nope. Would have lost you $3. $3 on a dollar, what, $1.55 credit or something like that. Wouldn't have been a good trade. But I need you to know it in case you're going to end up having to adjust to it down the road. All right, let's call it a day. I'm going to, what I'm going to do is I'm going to start to convert this tonight. I'll give you our adjustments that we made today in the paper trading account, our little portfolio we started at the beginning of the year. Keith, out of curiosity, are you still beating me? Even with Bybee? So Keith's making me look bad, but good for him. Good, Keith, that's going to show you take a profit as often as you can when you can. We're still up about 7,000, kicking the trash out of the market. That's about a 7% return on a market that's only up 1% right now. So good positions to be in. Guys, have a great week. Any questions, don't hesitate to email me. I'm going to email you the adjusting of these two spreads so you'll have them. And we will just go from there. Guys, take care. I'll talk to you soon. Have a great week. Bye-bye.